Hi, I'm Keith McCullough, and welcome back to another Real Conversation. We're going to do a four-way here. It's my first foursome, so to speak, in the Real Conversations. And I think you're going to learn a lot. I'm constantly learning from these gentlemen. We've recently partnered with them, and I'm proud to introduce you guys. All three of you are in studio.
Yeah.
Mike Green, who many of you know, Craig Peterson, and we have the Ranger. We're going to get into this a little bit, Dave Pegler. But I first of all, just welcome. It's the first time we've been, as a team, sitting together.
All together, yeah.
And these markets obviously are markets that are constantly challenging people on their fundamental premise. So I want to get into why what you see on your screens isn't what you may have thought that it was, or it could be, or certainly how old wall media, as I affectionately call them, characterizes daily or even hourly market moves. Right. So there's a lot to get through here, but first I wanted to A, welcome you, but B, give you a chance to introduce your teammates.
The tier 1 team, sure. So most of you guys know me as the chief strategist of Simplify Asset Management. It's an opportunity and a role that I relish and really enjoy. But one of the things that's been fantastic about kind of the past couple of years has been the opportunity to get to know people who have non-traditional backgrounds in Wall Street and kind of amplify a lot of this stuff, right? And so Tier 1, I actually stumbled onto Craig and David over the past couple of years, found that they were replicating a lot of the work that I was doing in the options space, and Craig's work in particular on the programming side just really caught my eye. He was building models that were replicating a lot of the stuff that I was seeing on Wall Street. Mm-hmm. And candidly, he was doing it better and faster than I was certainly capable of doing it, which became particularly important as I transitioned away from hedge funds and into the ETF space, where candidly the budgets just are not there for building the exact same sort of thing that you might have otherwise done, right? The profit margins are much less, the focus is much more on making sure that retail has access, that they're low-cost products, et cetera. So building that research organization, I've worked in a couple of different ways to try to recreate that. One of those has been partnering up with the guys at Tier 1 as an advisor to their firm. So Tier 1, just as quick background, Craig and David, they both have totally non-traditional backgrounds, which is hysterical for me because I've got the Wharton undergrad and stuff.
Where's that?
Exactly, it's a school in Philadelphia, not Penn State. But the simple reality is that there's tons of incredibly talented people out there that have these kind of non-traditional backgrounds. That as Wall Street has become more and more about computers, has actually become basically the talent being elevated in ways that you wouldn't expect it, right? You see it totally differently. Craig is one of these crazy programmer talents that you meet and you're just like, oh my gosh, why am I even bothering to touch the keyboard? Because this guy can do things so much better and so much faster than I can. But his background, right? I mean, the guy started as a firefighter, right? So I mean, ironically, he grew up a couple of miles away from where I grew up in Silicon Valley. But his background couldn't have been more different. His father was a municipal water employee. His mother was an administrator at the local school. And based on that background, he goes off and he becomes a firefighter. And then he goes from firefighting into the military. And then from the military, he finally heads off to college, decides to study business, and then decides in 2014, I'm going to teach myself programming, which took him about 6.5 minutes. The guy is just unbelievable, right? And here we are today. He's now the guy who's responsible for building the models, and it's basically look, here's what I want to do. And 15 minutes later, it's okay, how's this look? I'm like, oh my god, this is crazy. What
it is. It really is.
It's really
with that
amazing.
Context, because I didn't have all of that context, and of course I have all my biases. So now you know why I like you so much. My dad's 38 years as a firefighter.
I didn't know that.
Yeah, and no, it's just it's borderline. It's bombastic, I guess, would be a word that somebody might use on Wall Street to say, this guy sees it.
Yeah.
Like we talk about hockey. Do you see the game? Do you see what's going on inside the game, inside the flow? You see it as well as anybody that characterizes it, which is awesome. That's the way it should be.
It's really, really cool.
Right?
It's really awesome. And it's a constant reminder that, really the opportunities that are created for us by our parents, this is something I spend a lot of time talking about, but are created for us by our parents and by society really determine a lot more of where we end up in life than actual talent and meritocracy, right? And so the opportunity to work with somebody like Craig is just absolutely fantastic. And then David, of course, one-ups him by coming from South Africa, which is why he can't really speak English or write it well. But David went to school in South Africa and then decides to follow the American dream, serving the U.S. military to become an American citizen, and gets himself blown up in Iraq and gets a Bronze Star, And then the recovery process is like, well, what can I do now? I'm physically disabled and bald, and
Both handicaps.
Both handicaps.
Yeah.
And decides to start trading in financial markets. And he and Craig met each other through mutual acquaintances. And David, exactly like I did, recognized Craig's innate talent. Both of us having very little talent of our own, we decided to glom onto Craig. And next thing you know, you guys have launched Tier1, which when I stumbled across it, I got to tell you, it just absolutely blew me away in terms of what you guys had started the process of creating. And from there, we've continued to build.
I think with Craig, a lot of the times he produces work, he'll go dark for 24 hours, you won't hear from him. And then he'll come back with
I'll always answer
4
your guys'
models.
emails, don't worry.
He'll come back with 4 models, of which I have to say, well, now can you school me? Because I have no idea what you're doing here, but I know it's important.
That's my interaction with him so far too.
100%.
For me, I need to engage in, like, if we make something tangential to our process or embedded in our process, like I told you guys in the beginning, I have to engage with this, and I have to engage with it daily. And Craig's like, well, what time do you want it? Yeah. And I said, early. And you're at whatever, 1 or 2 in the morning East Coast time, everything that he's dug into is sitting there, and I feel like the most privileged person because I get to look at it first, right? And then I work that into my flow, into what I'm communicating. So thank you for that.
Yeah, absolutely.
And I guess the next part of this I want to get. How did you guys get together, and then how did the founding of Tier1 Alpha actually happen?
Well, I'll give you the 30,000-foot cliff note version. So we were introduced, I got into FX, I don't know, 16, 17 years ago, and through a mutual friend was introduced to Craig. Mm-hmm. And Craig is sort of elite intelligence, and he would pick my brain a lot of times of what does this mean, what does that mean? And I'm more on the, I know it's a 4-letter word, trading side of things, and Craig is more on the investing side, so we'd kind of have to join forces there. And then he would start producing macro charts, just what do you think of this, what do you think of that? And so we developed sort of this big macro framework behind it. Mm-hmm. And then as the crypto thing was sort of taken off, we have always had this fervor for the man on the street needs access to all information. None of this needs to be behind closed doors. So we came up with this bright, harebrained idea to start a company that tokenized the tokenized SPA basically on the Ethereum blockchain. Mm-hmm. So we thought, hey,
this
if
was
you're
the earlier days of
crypto,
too, by the way.
Yeah,
Before,
this is
like it was the Wild West still. There's zero talk of regulation at that point.
Mm-hmm.
Yeah, it was definitely early on.
So we wanted to stay out of the Sam Bankman-Fraud jail cell. So we tried to get ourselves regulated. We went out our way to get ourselves regulated, and nobody wanted to touch it.
Yeah.
And
we couldn't even get a conversation about it.
The idea is that if you're a Brazilian plumber with 5 employees, can you get a retirement account trading or having access to US exposure? And so we wanted to tokenize that opportunity. So we had all the technology, but the bottom line is even the BVI attorneys eventually said, hey guys, go forward and break stuff, and we'll fix it as you go. And we thought, well, that sounds a lot like a prison sentence.
Yeah, that's not the way that we like to roll.
So then,
right from the start.
That's good. That's good, guys. That's a good
start. Makes me feel so much better.
Our relationship is still on good footing. Because I've had relationships with people in crypto that have gone the wrong way.
I mean, the writing was clearly on the wall that even if we
we
wanted to get regulated, there was no shot. Mm-hmm. So then we made a hard pivot into what we're doing now, which was always something we were working on in the background, but we figured, okay, now let's do this all in. And it's been complementary to everything I do in my trading process, what he does in his investing process, and so it's sort of turned from a subsidiary thing into a major part of what we do every day. Mm-hmm. That's how it came about.
When do you think, Craig, you finally had a template that was like we like to say, content that we can commercialize, that we could show people?
Well, like David said, we've been doing this just for ourselves for years and years and years. So after our soft, landing with the crypto business, we came back in and said, all right, what are we going to do next? And we were talking about different software and stuff that we could work on. And then just kind of through that process, we got really into the research, and we started posting things on like Twitter and stuff. And then that's when we linked up with Mike Green, and Mike immediately said, you guys need to package this up and start selling this as a newsletter, start selling your research. So it's just been rolling since then.
Yeah, and how many years is that now? Or are we into?
About a year and a half.
Yeah.
This is relatively new. I mean,
Oh yeah.
what's really new, and it's still a lot newer than most people would even like to admit, or many would, I think they would at this point. They're so like almost beyond apoplectic or frustrated with how markets trade. I mean, this is really new to people that invest. So if you say, and even to people, I don't want to delineate between investing and trading. I mean, it's really new to people that are looking at a screen of something that's ticking that's called the market.
Yeah.
And it's an entirely different view than what I would say. I don't know, say at least 80%, Mike, of people.
Yeah.
80% of people that I consider like my peer, my friend, somebody in the business that's fundamentally oriented, research driven. That it's real. I have to walk them through what your charts are saying, for example.
Yeah. Well, it's really hard, and occasionally you see us actually write this in the language, right? We realize this sentence sounds crazy. Right?
Yeah.
We realize what we just said sounds like absolutely insane, but it can be something along the lines of, I'll give a very real world example, right? So prior to Jerome Powell's latest speech, right, at Jackson Hole, the market had actually bid up protection in advance of that action, right? And so we saw implied volatility on very short-term dates, and this is one of the wonderful things about zero DTEs, zero data expiry options, is that you can actually isolate the very particular event. That's the sort of thing that we do all the time, is basically say this event is being priced in the market as something that is being hedged, right? This is a fear that exists in the market. How much is being priced for that? How does that differ from the days surrounding it, right? You can literally look at Monday is priced different than Wednesday, for example, right? And what we saw on that type of event was that people had broadly hedged themselves going into the event, right? Now, if something has been broadly hedged and protected, the odds are very high that it doesn't matter, right? It just doesn't actually matter. And that's exactly what we saw. And perversely, even though the data can come out and it can cause all sorts of other things to go wrong, if it's been hedged and it then turns into nothing, the irony is as those hedges evaporate, basically people start trying to unwind them. And as they unwind them, it turns into a bullish event for the market, which then is presented on CNBC as like, well, Jerome Powell was very bullish in his speeches or very dovish in his speeches at Jackson Hole today, and therefore the market's rallied. And you're like, that's not at all what happened, right? I mean, this is completely absurd. And the minute you start to recognize this stuff, right, the second thing that then becomes really apparent is that a lot of the systematic strategies that we highlight at Tier 1, the flows that are determined purely by mechanical properties in markets today, things like target date funds, things like volatility targeting funds, trend followers in the CTA space, et cetera, they don't care. All they're doing is just reacting to the information that came through in the pricing of markets in that day. Right? And once you recognize those mechanical aspects, that's actually a really fun kind of breakthrough, right? You stop saying like, well, what are markets pricing in? And what does some hedge fund manager think is going on? Or what does Mike Green think is happening in the economy, right? And you just recognize, man, so much of that doesn't actually matter because it's just P&L determined for that individual day.
If you take it all the way back and you take Mandelbrot's view of the world, and you started there, which most people don't, so let's just say it's not even 80-20 on that ratio. People are linear econs, they think in steps, they think fundamentally on valuations, starting points, et cetera. They don't start with the basic assumption that most market moves are just Brownian motion. Okay? So if you just assume that, which I think you and I do all of the time, and know that artificial intelligence was around then too, you'd be like, oh shit, now I'm in love with artificial intelligence, and the fundamental premise is why doesn't matter, just do what is. And here we are, we're still in the same, like at least for me, this fits. You guys fit within the continuum of my ongoing education about how this bloody machine works. But it's not like it came out of nowhere. It's just going faster, a lot faster.
It's going faster, and then there's a second component, which obviously I'm all known for talking about, the dynamics of passive, right? So when you start taking more and more of the market, and you're putting it under these super simple rules, right? And I always highlight the rules of passive are literally the world's dumbest algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. And if you didn't do either one, don't react, right? There's no reaction function whatsoever. All of that is causing markets to become more inelastic. And so these mechanical properties that we highlight just become bigger and bigger influences on the market, right? If nobody else is actually reacting to the fundamental information, there's nobody at Vanguard who's like, oh, Apple's earnings were great, let's buy more Apple, right? It just doesn't work that way. when that becomes more and more dominant in the market, the things that we're watching, you and I as 30-year veterans of the market are like, this is nuts. Like, this doesn't make any sense fundamentally at all, and it doesn't.
I'm good with it now. Like I'm as soon
There's
as
an element of Zen, definitely.
I'd say accept it. I always embrace uncertainty. That's part of the game anyway. But now you can actually take advantage of other people just being on complete fundamental or emotional tilt when these things are happening. You're like, oh, okay. So let's use an example. Like, Mike used the most basic example that he's talked about forever, which is flows, passive flows. But use vol control funds, how you talk about that, Craig. And can you explain, A, what that is, B, what's some of the basic language to describe what they're doing, like volatility scaling, for example. These are things I learned from you. I'm like reading this, I'm like, huh. And I just look at my little chat GPT, I get some more definition on that. I'm like, oh shit, that's just like that dog in my neighborhood that always barks every time this happens. Yeah, he doesn't have to tell me his life story. I know exactly what happened. A fox ran by that dog and he barked, right? That's it. But I don't have to know that to just ignore it. I can stay with it. So can you use that example and the flow of that? And we'll go through a bunch of them.
Sure, so vol control funds, the whole point is to manage levels of volatility. You want a consistent level of vol in your portfolio or in your strategy. And this is really useful in places like the insurance space where they're trying to hedge out variable annuities, but they need to have the ability to draw from their funds without having these big drawdowns if there's a market event, a 5% drawdown or a 10% drawdown. So to be able to protect that, to protect their assets, they use volatility control, which looks at realized volatility as this toggle for their equity exposure. So realized volatility is like historical vol, it's what actually happened, compared to implied volatility, which is derived from the options space, the options market. So realized volatility is backwards looking, which is kind of an interesting point about it, versus forward looking. And that means that there's some inherent predictability on what volatility is going to do, because we know what data is being used to calculate realized volatility. So, he talks about passive and give me money, I buy, take money, I sell. It's not that different in the vol control space, where if realized volatility rises, they have to sell their risk exposure, typically equities. And if realized volatility falls, they have to buy more equities in order to maintain that constant level of volatility in their portfolios. And there's a little discussion around how much assets is under management with these funds, but somewhere between $250 to $350 billion. And these funds are very mechanical in nature. So when we talk about things like buying and selling in an inelastic market, these flows can have a really big impact on the underlying assets, which is typically futures or whatever else.
Which is why I use the very basic example. Dan Holland always tells me, tie it back to things that people know in life, right? If there's some kind of a thing going on near an animal that's outside, then they might bark. Okay, so this happens, vol controls, rules-based. You can predict what they're going to do. The one chart, I think, guys, if you can show it, it shows in their stat pack shows 1 month versus 3 month vol. And the flip that we just saw recently, maybe if you can walk through that, which is different. And I think if you guys, to use Craig's language, if we use throttle and toggle, we're going to go back and forth between that chart and the vol control fund flow chart, exposure chart that is coming. So one's coming off its lows, and the other one, the next chart, if he finds it, is going to be coming off its highs, which is the flow of it all. Can you explain why there may be something to really pay attention to here or not? Sure. I like how you describe it in the morning, by the way. It's like, maybe not.
But well, that's how it is. We don't know what the returns are going to be that day. We could have some clues about it. We could look at gamma exposure and say, is volatility likely to be higher or lower today, and how does that affect these other flows? Right. But generally, if you go in with the mindset of I know how this works, and then you can watch the market in real time and see what it's doing, well, then you should know how these funds are going to be reacting. In
particular, from asymmetric points. I mean, you're coming off the peak of the flow, the chase, and you're coming off the bottom of the relationship where you didn't really have to deal with 1 month vol.
And
there's the exposure. So like right there, people are like, oh, was it NVIDIA? Well, that's part of the narrative, but it was a lot of flow, is what it was.
Right. Oh yeah, big time.
And that's an amazing thing, those two things to look at. So I guess the fundamentals would say, okay, I need it a little tighter. So if we continue to see 1 month vol trade above 3 month realized vol,
Right.
is that bullish or bearish for the S&P 500?
Bullish and bearish, I don't know if I would even use those terms, but I would use, is there going to be more volatility
Yes.
or less volatility in those aspects? And due to volatility scaling, which looks at either, longer term realized vol, so like we use 3 month, or shorter term one like the 1 month, volatility scaling basically decides which one of those is going to be that toggle for equity exposure, but which one is higher at the time. So when the 1 month vol is higher, we typically see vol control funds have these larger rebalancing flows because the 1 month vol is just more reactive to incoming data. There's less data in the entire sample to kind of, smooth out the returns. So when the 1 month vol is higher, we tend to see more flows, buying and selling flows from the vol control space. And that increases, has the potential to increase volatility in the underlying assets.
Yeah, this is like when I built my trade trend tail model, the relationship between trade and trend, trade 3 weeks or less in your time series, trend 3 months or more. So that would include all the fundamentalists in terms of what they're looking at, whether it be imputing it through quarterly earnings, et cetera, et cetera. But what I was doing there was I was trying to front run my former employer's behavior. The rules-based system, magnet-targeted risk management system, I know that when 1 month flips, that you have to move. You have to change your exposure. So why not like, let's just take a step forward and try to front run that by a week or two. You don't want to be too early because you can get your face ripped off.
Right.
But front my immediate term, that's why I do these things, to front run the kind of flow that I was observing internally. Now, what you guys are talking about is like externally and a shit ton of flow. Like it's all of the flow.
Yeah.
Is there a risk that you're going too micro, like almost I am arguing that I am, before seeing what you're doing? In other words, just looking at CTAs, just looking at vol control funds?
Well, so let me actually hit that, because what you just described, by the way, is exactly the way these rules get built in, right? So a firm like Magnetar would observe, okay, volatility tends to cluster, right? And we can avoid a lot of the risk if we step out when the trend turns negative, right? And so they then adopt trading rules that say, well, when the 1 month vol becomes more volatile, when realized volatility rises on a 1 month basis, we reduce our exposure because we don't want to be exposed to the highly volatile events, right? That's what they're doing. That becomes formalized. Other people notice the same phenomena. They formalize it as well, right? Now we go to insurance companies and somebody says, well, we've done research, right? And the research says the volatility tends to cluster. And so if we're running on a value at risk type model, we can actually reduce our regulatory capital requirements by reducing our exposure when volatility picks up, right? And so these rules become formalized, and at every step in the process, they're effectively trying to do exactly what you just described. They're trying to predict how other people are going to behave.
Yeah.
Right? And the longer the history of these things, the more they become basically set in stone until an event occurs that basically blows people up, right? COVID was an interesting one. It blew a lot of people up in the volatility selling space. Volmageddon, another one that blew some people up. The global financial crisis blew people up, right? All of these are events that change the markets for a period of time. One of the things that's so interesting about what's going on right now, though, is as more and more strategies become systematic, as more and more people are able to point to, well, here's what worked in the past, right? The computer technology is there. Perversely, it actually basically causes these ruts to get deeper and deeper and deeper. The wagon wheels basically follow the same path. More and more people start doing the exact same thing. And it sets up these weird dynamics where when it breaks, it can break really violently. And so when you ask kind of this dynamic of like, are you running the risk of getting too granular? One of the things that I would actually highlight is that, again, this is one of these things that Craig has done that I would challenge a lot of other people to think about. Craig has built actually integrated models that allow us to look at CTAs individually, that allow us to look at vol control funds individually, that allow us to look at the options market individually, but then we can actually run them together and talk about how they integrate,
which is
and
great,
how they react with each other.
Which is like how I think about macro. I mean, and when on the macro shore with clients, they want to, it's Occam's razor, right? Like they want to simplify the complex by having a simple 50-day moving monkey, or they have it's that or it's this. That's the nature of human beings. They want Y to be simple. Right. And I always say you have to look at everything, all of FX, all of rates, to understand what what the interpretation was on Friday of the employment report. I mean, it'll take some time, but we have to look at all of it. When I look at the competing product, I would say, to what you guys have built, one, it would be on institutional desks.
Sure.
because two, it wouldn't be on the buy side because it won't give it to you. That's why they're running their strategy. That's part of what they're telling their clients. But it's on the institutional desk. When I look, like, I wouldn't name names, but like if I were to look at the Goldman Prime report, they are actually going to see some, like, it's not the same depiction. When you look at CTA flows, for example, or you look at, I wouldn't even say that they're even close on vol control, funds and that flow relative to you. But on CTA flow, a lot of people would a lot of PMs that I know take the Goldman Prime data and as flow data that they need to pay attention to. But not just because it's flow data doesn't mean it's the same depiction of this flow data.
Sure.
What do you think about that? Because I know you're going to have a response because you already did when I first started asking you about this.
I think there's a tendency to simplify a lot of these things, and like when we're looking at these models, one thing that you have to understand is like we'll look at vol control funds as a volatility scaling strategy with these very specific trailing vol windows and everything else. But at the end of the day, shop by shop, desk by desk, they're going to be doing things, broadly differently. So when we build our models, we try to capture what the bulk of the strategy is, like what's the core concept of the strategy, and then try to tie in we know how much, generally, how much assets are under management for this specific strategy. Yep. This is all public information. So we can try to extrapolate how much buying and selling flow there has to be. But when we compare our models to a lot of other desks, I think there's a tendency to oversimplify what's going on, and we like to not overcomplicate, but we like to dig into the details about what's going on. And we spend hours and hours going through academic research papers and looking for what's been written about, what's been tested, and this is what a lot of the institutions are doing as well.
Well, again, it's back to Mandelbrot 101. Not to give the guy, rest in peace, all the accolades, but he nailed that one too. Mm-hmm. He says it's the particular that matters, not the average of things, the valuation of things. It's the particular thing at the particular time that somebody with a process realizes before the crowd does, right? So,
if I can just add to that. So one of the conversations that Craig and I have all the time is I'm more macro orientated, being on the FX side. So a lot of our conversations will be challenging my macro thesis or challenging what I'm seeing on a dollar correlated basis.
Yeah.
Because Mike and I talk about this. The dollar is the big bellwether to all things. If you get that right, you get a lot of things right.
Yep.
In the investment world. And so the letter's written with gamma up front because that is sort of the volatility throttle for things.
Yep.
And then it flows down from there. So, we have our bonus section and chart section, and I'll write something macro there, and a lot of times it's bearish because I think the world's going to shit. But then, I'll have a conversation with Craig and I'll say, well, what are you seeing in the vol structure of thing? And he'll say, well, no, it's all bullish.
Yeah.
And then so I have to say, well, this is all terrible, but ignore it. Like, read up, because we're probably going up for a week. Mm-hmm. And that's challenging for me as a human because my brain is saying, oh, I should definitely be max short. Meantime, I'm hitting the buy button a lot.
Yeah.
And that's the beauty of it, is it's not an opinion. It's just a quantitative view
it's huge.
on will they be buying this week? And Craig's so deep in the weeds with his models is that he's very good at front running certain scenarios. So what will be coming into the sample group now for vol control? What will be coming into or what will be most importantly dropping off? So these big volatility events are dropping off. Well, the market would have to have some big exogenous event now to be able to trigger a higher level of volatility to mean more selling. So this is a buy here. Mm-hmm. Meantime, my fundamentals are saying, oh, I don't want to do that, but I'm going to. And so that's the beauty of it. It is 100% quantitative. It doesn't matter an opinion.
Yeah, which anybody who's subscribed to us for a while knows, my batting averages just went straight up since actually embedding what you do into what I do. It's one thing to read something, find something interesting. If you listen to Mike Green, you can do that all day long. You're going to be fascinated about everything he can teach you. But for me, it's like where the rubber meets the road is where does the Tier 1 Alpha data and what did Craig say last night? What is that? It's helped me tremendously. How 100%. Else could I have? I'm a raging bear. And I've gone multiple times covering all my shorts, which means, I'm running long, and quite bearish, right?
Yeah.
So I've been able to do this over time anyway, but this has been highly augmentative, is what I would say, because it gives me that one extra quantified reason to say fade whatever fundamental is in your head. I think that's a critical thing. So that's one thing. The second, you mentioned words that you guys use that I want you to maybe put a little bit more meat on the bone. You say, gamma is the throttle, and what's happening here in terms of daily vol is the toggle. Can you just give people a little bit better understanding on why you think that, and well, you think that because it's true, but like why that's a better way to think about the market than, well, it's trading at 18 times forward, and I think it should trade at 16 and a half.
Well, I could tackle this one. So we say that because coming back to it, if we try to simplify these like really complex topics, and they are complex, and we use a lot of funny words, I guess, as well. And I know that complicates things time to time. But
well, gamma in and of itself, to somebody who's not mathematically oriented, is a tough word.
Like exactly.
It's not a gummy.
Mm-hmm. It's unfortunate. Well, it's not unfortunate, but it's this is the language that's been developed around these types of market dynamics.
Mostly by firefighters, by the way.
Yeah, I don't know about that one, but so it's the ones that we have to use, and it's the terms that describes different situations and stuff. But if we were going to sum up like what we do at Tier1 Alpha, we're going to sum up our product. It's looking at flows. It's looking at flows and positioning. And we look at gamma exposure as the throttle, the driver of volatility. If we have negative gamma exposure, we tend to see higher volatility. If we have positive gamma exposure, we tend to see lower volatility. And whatever that volatility is doing has big impacts on all the other systematic strategies that we follow. So for vol control, for instance, if dealers are in negative gamma, we tend to see realized volatility increase as they're chasing around their deltas, everything else. Again, the funny words that we use. But we see realized volatility increase, and that causes these vol control funds to mechanically, and I say mechanically because it's all computer algorithms, right? Like it's not somebody sitting at a desk saying, "Oh, realized vol went up, I'm going to sell today." This is all fully automated strategies. So realized volatility goes up, and it forces them to start selling, and that's when we can see a directional component in the markets. So when we think of volatility, it's bidirectional. It goes up big days, big down days. But when things get volatile, we tend to see markets trend lower. And we think this systematic positioning is the reason why.
Yeah, so let's go through that a little bit with some pictures. Guys, if you can show the gamma charts, like where dealer gamma is positive, neutral, or negative. Let's go through all three of those things, and just for even a neophyte like me, like what does it mean when gamma is in a negative position, which it was all the way up until this Powell event that Mike talked about?
So let's actually try to pull up the chart that shows gamma exposure for the S&P 500, and we'll talk off of that. And this is going to show us. Let's go back one chart. I think one more.
Oh, I'm not sure. I'm not sure if I have that chart in here.
You don't. Okay. All right.
Gamma curve, yeah.
So, all right, let's go back to the one that you started with then. We'll work off of that. Make it easy.
Gendron is very good at macro.
That's okay. So let's bring up that by strike picture, just to help people. All right, perfect. Okay, so the first thing to understand that what we're actually trying to describe here, you can actually see this picture here. You can see where the S&P is right now, basically, is that center point. On both sides of that, there's options that have either been bought or sold, and the dealer exposure is going to be a function of whether that was bought by investors, or whether it was sold by investors. One of the more typical ways to make money is by selling insurance in the form of options. I own Coca-Cola stock. I want to make some additional income associated with it. I'll give up the extreme upside of that by writing a call, for example, right? When I write a call or sell a call, the dealer is on the other side of that. The odds, unlike selling a share of Coca-Cola, the odds that there's like another person who happens to want to buy that exact strike at that exact time, at that with that exact expiry, is vanishingly small. And so options markets are different than what we call Delta 1 or the underlying markets. Coca-Cola is basically a commodity. Once I've decided I'm going to buy and sell it, there's always going to be somebody on the other side of it. The options work differently. The dealer is there on the other side of it.
Yep.
And the dealer doesn't want to take directional risk. He has no idea what's going to happen with Coca-Cola. He doesn't know what the information content I have, et cetera. So he's going to respond to my buying an option or selling an option by what's called delta hedging, neutralizing his directional exposure to it. And gamma is really just a really simple concept when you break it down in this way. It's how much that delta hedge ratio changes for a change in price of the underlying, okay? So if the dealer is short gamma to the top side, right, meaning they've sold call options, if markets go higher, that means they actually have to buy more shares of Coca-Cola to maintain their hedge. This creates conditions, if the dealer is short gamma, they tend to perpetuate volatility in the direction that the market was going. Same thing to the downside. If people have decided that they're going to buy protection in Coca-Cola or the S&P 500, right, they buy put options, the street has delta hedged that. If the market goes down, then the dealer is actually more short. They need to sell more, or more long than they expected to be. They need to sell shares in the S&P 500. They need to sell futures in the S&P 500.
Sell on the way down.
Sell on the way down.
Yep.
Right, and so anytime the street is a net buyer, the investors are a net buyer of options, which tends to happen when people are worried about things like Jerome Powell giving a speech. I want to protect myself. I want to make sure I'm not sure what's going to happen. I'm going to buy some protection. Anytime that happens, that tends to exacerbate volatility. On the flip side of it, when people are feeling really confident, like, oh, you know what, things are really stable, I feel really comfortable about this, I'm going to sell downside protection. There's nothing that can cause this market to go down. Jerome Powell has our back, or Fed printer goes burr, or whatever, right? They're super happy to sell that insurance to profit a little bit extra. Well, you're gifting that to the dealer, right? The dealer is suddenly like, okay, well, now I need to worry less about the hedging dynamics, because if the market moves, it's going to move in my favor and against you. Right? And so under those conditions, dealer hedging actually tends to go in the opposite direction of what the market does, and perversely, that actually compresses volatility. Right? And so these are the mechanical aspects that have increasingly taken over the way that the market behaves. And crazily enough, we try to attach all these narratives around like fundamentals to it, right? Like, it's just not really what's happening in a lot of situations. David used the term exogenous, and you'll see this word all the time in Tier 1, right? Because that is actually the key risk.
Yep.
Look, if North Korea lobs a missile, you can't tell that that's going to happen by what's being priced into the options market. That is an exogenous, something happening outside the system that can cause it to change. But those are the key risks that exist, right? Those are outside risks. They're not something that's actually inside the market. The market's not trying to determine them, et cetera. Jerome Powell makes a speech. That's scheduled in advance. Participants try to hedge that uncertainty in advance. Well, guess what? It's now priced out of the market, right? The market is unlikely to respond unless he comes out and is like, I'm going to destroy all you guys, right? If he came out and said that, the market would definitely react to it. But if he comes out and he says kind of what we expected him to say, the next move is up, because the hedge ratios fall.
It's amazing. I'm just being bluntly honest about this. I mean, I did not know what the dealer gamma flip line was until you told me what that was. Like, I didn't even know it was a thing, okay? So flip means, okay, it's either neutral, it's bullish, or it's bearish, right? You flip above or below the line. As soon as I was weaponized with that was good for me, really good for me.
It's a really powerful concept.
Because I know what the macro calendar is. I can see when Craig first wrote, he's like, look, that's the event that people are, you saw, at the money implied vol was bid. I think what was it at 19 at one point? It got close.
With Powell, it was around 19.
I mean, Friday it closed at 12.
Yeah.
I mean, so, but I was positioned for that coming out of this July month-end markup. As soon as that thing flipped to negative on dealer gamma, now we're in the throttle went negative. This is throttle to toggle. And my immediate term trade line broke down, and I have multiple catalysts that are negative that can be construed as negative. I'm like, voila, press the shorts. Like, that was easy, right? In as much as when you start to get rid of that date, no matter, that could be, according to people in my religion, the second coming of Christ. I don't care what that thing is. It's just that you showed me what everyone thinks that it is.
Exactly.
And that was like a huge thing for me. I mean, people could say that I've been on a run because I've been lucky or whatever. I think I have like 20 in a row in real-time alerts on the short side and on an up market.
That's awesome.
Right? Because I take them all off quick, and I'm just using what you're telling me, and that's not going to continue. This is just like, I'm okay to say it because it's not, and that's the beginning, as you know Pegler of the end for me, right? I'm about to lose money. But this whole concept of that's the throttle line, and then being like more like Pegler like this morning, and then you write, but just because it's the throttle line, it doesn't mean that it has to matter yet, because that's kind of neutral, and for now until it's not neutral, it's really nothing, right? Which is something too. Doing nothing's a position.
100%.
Right? So
more times than not.
Yeah, so to me, I'm saying it in as many ways as I can, but that's how I'm using these lines. So if somebody isn't even well equipped at understanding even what gamma is, they should understand what the flip line is. And then just take the time to teach yourself. This shouldn't be that, I mean, it is actually hard for a normal human being to understand what you're saying.
So trust me, my wife tells me that all the time.
But it's not hard to understand. If they can know where the 50-day moving bloody monkey is, they should know where the flip line for gamma is. I mean, that's critical information.
It's the same underlying concept, right? I mean, you pay attention to the 50-day moving average because other people pay attention to the 50-day moving average. In this case, you're basically saying, okay, well, what are the rough rules that are governed by those who are closest to the market, right? And just remember, like, nobody who's actually making markets and options has the time to sit there and be like, oh, what do you think Coca-Cola's earnings are going to be, right? Like they can't do that, right? As Craig is pointing out, it's purely mechanical. And so they have these rules that are set in place. And all we're doing is saying, like, look, this is where these rules matter, right? This is where it's going to influence it. And you're just trying to put the odds slightly in your favor, because as you point out, like 20 in a row, that's a really unusual occurrence. If it happens like on a regular basis in craps, you're a huge winner, right? But the reality is that you're going to be governed by the odds of probability, and you're just trying to give yourself a little edge.
Yeah. If it happens 40 times in a row, there's going to be an investigation into
exactly.
into Madoff, McCullough, or something. But I mean, it's. I'm just trying to give people a sense of like the practical nature of this, and tying what a lot of people struggle with what you said, which is I'm bearish, and because I'm bearish, I can't make money. That's bullshit.
Completely.
And if you can't trade the volatility of your assumption, then you will be bullshit, right? You're just
100%.
not going to be able to play the game.
And a lot of times, here we are saying gamma's it. A lot of times it doesn't actually mean a gamma flip isn't this is a nuclear situation. Dropping, and a lot of times it's relative to how much systematic exposure has actually been accumulated and how much has actually been deleveraged. A negative gamma flip, when everybody's heavily leveraged to equities, that's probably going to matter a little bit more than at a time where everybody's already deleveraged through a protracted period of time. Okay, well then we just volatile because we have, we've, like you say, the market crashes from oversold. That could be a situation where, okay, well now we're heavily deleveraged and now we're going to flip back positive. That's, it's relative to where the positioning is.
100%. I mean, like, it's the particular that matters. It's also the conditional factoring. Where did you come from? Like, go back to that vol control flow chart. We came in July. You had an outright capitulation in all that is.
100%.
I mean, you, from looking at hedge fund positioning, gross versus net, looking at leverage in the system, like even according to the FINRA data, which you guys have cited and shown me, it's like every single thing flipped to I have to chase this. I have been wrong, and I have to chase this thing. To that thing turning for the first time off. That's not just like a local high. That's like, I call that the mother of all bubble highs. I mean, this is not an inconsequential. Like I always say, it's not a place to do nothing.
Well, I do want to push back a little bit, because while we show that in terms of the localized component, we still actually are not back at the 2017 levels, which
really?
I actually think
on vol control?
Yeah, on vol control.
Correct.
My God.
I really want to emphasize that, because I actually think that there's information content there as well, right?
That was coming out of another time where people were, particularly if they're political in their positioning. Trump?
Yeah.
I'm a seller of Trump at the end of, our model went bullish in Q4 of 2016. I got accused of loving Trump. It's like, because people need to, but I remember that period. I did not look at your data back then, so I wouldn't know that.
Well, it's one of these crazy things where if you actually think about how elections work, right, and this would be a perfect illustration of it. if you remember, Justin Wolfers, an economist at the University of Michigan, came out and was like, "Well, I've studied the reaction of the futures market in response to Hillary Clinton outperforming Donald Trump in the in the debates. And when Hillary, makes a good point, the markets go up, and when Donald Trump makes a good point or things that are perceived in Trump's favor, the market goes down. Therefore, if Trump wins, the market is going to crash, right?"
Yeah.
And that sort of analysis, like, it feels great from an information component where you think people are actually absorbing information. That's just not at all what happens. If you think about the uncertainty going into the election, it's the exact same thing as the Jerome Powell speech, right? It's implied volatility is up. People are hedging their underlying positions. If you're an active manager who's fearful of the Democrats winning, then guess what? You reduce your exposure. If you're an active manager who's a Democrat who's fearful of the Republicans winning, then guess what? You reduce your exposure. When the election resolves itself, what do you have to do? Well, it doesn't matter which way it went. You now have to actually increase your exposure, and so markets go up. And if you actually look at the last couple of elections, we've seen this on a consistent basis, and there's another interesting signature that's happening around those events. Same thing, by the way, we saw with Jerome Powell. Same thing we saw with the capitulation that you were referring to post-debt ceiling, right? Where it's like, okay, we were exhausted all the reasons to be bearish, like we now have to participate, right? What happens? Small caps rally, value rallies. Why? Because that's what active managers prefer. Right? They're like, okay, well, I can resolve this by saying I'm going to buy XYZ value small company because I've got unique insights into how it's going to benefit from this, right? Well, that causes small caps to outperform for a brief period of time. And people are like, oh my gosh, value's back, right? Everything's, like the world is right. And it sets up exactly that sort of top that we just saw, right? So these funny, weird narratives, right? As you start to dig into it and you watch the flows and you watch these types of behaviors and you watch the signatures of these things, you can actually kind of get yourself into a Zen place where, like, it feels a little nihilistic to be saying, well, it's actually just a giant variant of the Keynesian beauty contest. Doesn't actually matter what's happening. It matters what everybody else believes is happening, right? You got to figure out what other people are going to say. This is just trying to orient you in that fashion.
And it's happening in, I think the difference, because it's always different in the sense, it's just happening in shorter windows, right? I mean, Craig, the other day, I think you said it was 54% of ODT, of options volume were expiring, like, in the ODT window. I mean, that's nuts. Like, okay, now I'm doing it again, right? It's nuts.
No, it's not.
That's got to end in a bad way. Like the fundamentalist is sitting there, like, he's so bearish. I've lost so much money because I have a 25% short position in SPY from the wrong spots. It's like no. It is nuts in terms of how, like, another kind of component of my process would be like the Mad Major, John Boyd. OODA loop, the concept of observe, orient, decide, and act. And you're doing it when you have like a South Korean, like a MiG going to kill you in T minus, a third of a second. Right? You got to make a good decision at that particular point in time. It's almost like this is what's happening, is that it's forcing like that. To me, of course, that doesn't end well because that's just not sustainable. My hair has gone from one color to now it's gray to white, and next it's going to look like Pegler's hair. Right? I mean, it's to me, like, what do you think about that? Just this manifestation of 0 days to expiration options and how big of a piece it's become.
We've definitely seen a lot of increase in the volume in particular, and we've seen increases in options just to begin with. Really leading after COVID in 2020. And we look at things like the VIX as well and in the option space. And what we really saw is these longer dated options just had these super high premiums coming out of this big risk event in 2020. So I think that drove a lot of strategies who were just bleeding all this premium into these shorter dated contracts. And that's really kind of what kickstarted it. So when we look at just the volume profiles of 0DT options, it's risen in waves, and we're actually in one of those waves right now, which is interesting, right? But it's been in waves where it'll jump up and it'll stabilize for a while, and then we'll see another big increase in relative volume that will stabilize for a while. And the last one we had was when the CBOE introduced Tuesday and Thursday expirations for 0DTs. So like 0DTs, they've always been around, right? This is not option expiration is nothing new. First it was monthlies, then they introduced
quarterlies.
Or quarterly, sure. And then monthlies, and then they had weekly contracts. So when we talk about 0DT options, they're really just weekly options that are expiring on that day. So the new phenomenon now that we have is that there's just an expiration every single day.
Yeah, I mean, you have every single day on SPY, for example, but the weeklies are also part of the story. I mean, if you look at, which is I always encourage anybody who's paying attention, like always look at the MSOS, the most traded options board, and it's always ODTs or the weeklies in Tesla, Apple, the big stuff. Even Friday, like last week, people were like, fuck it, I'm not going to do this. I'm going to go back to chasing Nvidia, and I'm not going to try this with Tesla again. Because the more that they lose, the less behavior. I'm talking they. This is a dangerous comment because there is a retail community that trades this stuff.
Oh, sure.
And another part of they is a hedge fund community that is also doing the Keynesian joke that you just made, which they're doing it because they know they can force the hand of the retail community to do it. How is that like? And at the same time, people are, well, these 7 stocks, these are the magnificent 7. Well, they're trading in a magnificent bubble of short-term options. That's for damn sure. I mean, Apple alone last week, the chase in those weekly calls was epic.
Yeah.
Right. What changed in Apple's business last week? Well, China slowed again. Europe slowed again. I think they do business in Germany. That U.S. consumer confidence hit a new low. So you can't really put that in a fundamental frame, but you can put it definitely in terms of a month-end markup.
Sure.
And that had high options influence on that. Can you talk about that, the weeklies on the big ones, and how that might?
Mike, you might be better equipped for this.
Yeah, no, so I mean, this is part of the underlying passive dynamic, right? So when you start thinking about all the things that facilitate trading and facilitate the demand for those underlying shares, it seems only natural, like, well, we have daily expiry options in the S&P 500, so we should probably have weeklies in the largest stock. I mean, basically, the Apple is larger than the Russell 2000, right? So of course we need to have weekly options on that, right? Well, ironically, those weekly options actually require liquidity. They suck liquidity out.
Yep.
And this is one of the really perverse things about the whole passive dynamic is that the whole idea behind passive investing is that you're not supposed to influence the market, right? You're supposed to passively participate in things, right? Well, the great irony is that the language of passive, if you actually read back to the foundational literature on this, is like, well, the definition of passive is somebody who never transacts. Well, that's absurd because every single day Vanguard's getting flows. All of these, we're all trading in the S&P 500, right? We're doing all these sorts of things, and now we're trading out of money options, in the money options, zero data expiry options, some longer, et cetera. So we're all influencing these things in their participation. And so when you introduce options on a weekly basis into the largest stocks, what you're actually doing is challenging the liquidity on those even more, right? And you're creating conditions where there's a fundamental mismatch between how big these stocks are and their actual liquidity in the marketplace. They don't have the liquidity that allows us to do all this sort of stuff. And so perversely, as we try to do it, we're screwing the whole thing up, right? We're moving further and further away from the fundamentals, and it becomes much more about, I have to cover my exposure. I'm a market maker. Somebody bought a whole bunch of call options. I'm short those call options. Now I have to buy the underlying because the stock is going up. I don't care what's happening fundamentally. I don't care if China's getting worse. I don't care. I just don't want to lose money, right? I've got to run a delta hedged position.
That's it.
And so they end up being forced to buy shares. And the great irony, actually, you mentioned the retail components of it. We've seen the impact of the market of things like zero data expiry options, and there are actually very valid reasons why zero data expiry options are, inherently attractive to people who are selling volatility. But in the retail community, unfortunately, what we've actually seen is the losses on options have just doubled with the introduction of zero data expiry options. They actually have done more than that. It used to be the statistic was like $170,000 a day was being lost by retail accounts. Now it's up to $360,000 a day that's being lost by retail accounts with the growth of zero data expiry options, right? And it's this need to kind of gamble. Zero data expiry options are like the scratch-off lottery, the scratch-off lottery, right? The odds are terrible. It's a terrible game to be playing, but man, that little thrill as you're like, oh, I got 2. I didn't get it. All right, never mind. Right? That's really what you're actually seeing there. And so the professionals are selling these things. And the other thing that's really interesting about what's happening in zero data expiry options is about 85% of the volume is actually the dealers trading amongst themselves. Right? And it's because they provide the perfect mechanism to hedge their own underlying exposure, right? So Citadel may be short, Susquehanna may be long, just based on order flow, and they could basically swap amongst each other without having to step out of their native exchange, the CBOE, and going into the futures market where they could potentially cause disruption. And one of the things you may have noticed that we were writing about in the last couple of weeks is when the market was actually trending lower. This goes back to the point that Craig was making about these are, they're actually bi-weekly options. So the 0 data expiry options are actually introduced 2 weeks before, and then they mature forward. Well, if the market trends in that direction, there's fewer and fewer liquid options that are actually available, and the risk is that you actually are setting up an event where if something bad happens then, suddenly the liquidity in the market evaporates. Right? That's going to be the really interesting component. And so it's one of these things where, like, I would encourage people as another kind of angle on this is, like, when the market is basically going in a range, it naturally lends itself to trading in a range, right? Or to actually drifting upwards. It's where it starts to push to extremes that causes these last blow-off moves. And that doesn't feel all that different in a lot of ways than what we've seen in markets. It's just happening with greater frequency. It's happening on a 2-week basis as compared to, like, we've got a 5-year model and then it suddenly blows off at the very end and wipes people out. This is just happening much more frequently. You see these peaks and these troughs that are occurring. The last couple of weeks were a great illustration of that.
Yeah, it brings us full circle. We've already gone almost up to our time here, 56 minutes. I could talk about this all day.
No,
and to an extent, we do.
Yeah.
And that's what we're trying to negotiate all day long, at least in the hours of trading, is where am I at versus where would my fundamental pig-headed head be at? And the more you talk about that last part, the more you're like, Dave and I, like, this sucker's gonna blow.
Yeah.
And the more you understand it perversely is the more you could screw up trading it, because you don't stay pure to what Craig's signal, my signal combined with Craig's signal is telling you to do. I think it's cool, but it's still frightening. I mean, in so many ways. Some
100%.
people might take away from this conversation just that. The longer period of time there's just dealers trading amongst themselves, and the longer that the little guy is losing money, that's not sustainable. Like they could keep doing it while they're winning, but they're not winning in AMC anymore. They're not winning, in certain things anymore, so they just stop.
Yeah, it is part of what feeds bearishness ultimately is that you can actually detect an air of hopelessness in a lot of this type of behavior. And
Look at crypto.
It is really sad and it's hard to watch. But at the same time, it is a reality that we're facing in the market today. And you do need to understand, like, try to frame all these things, or at least I try to frame these things in the context of, like, your individual behavior.
Yeah.
Right? So, like, imagine instead of you're trading against the market, you're trading with your best buds, right? And it's like, I'll make a bet on this, and I'll make a bet on this, right? And you guys are all hanging out, and you're at the bar. It's like, let's bet on, does that person pick up their beer glass, right, et cetera. You can make a series of bets because they're all small in nature and they're short to expiry, and you can make 50 bets over the course of that evening, right? All are relatively low consequence. That's 0 data expiry options. It's one of the reasons I'm relatively sanguine about the effects until you get that kind of trending behavior where things behave differently. But if you think about what actually happened in the global financial crisis, what really exacerbated the global financial crisis, it was that people were making 10-year bets and 15-year bets, right? I bet nobody's going to default on their investment-grade bonds. I bet nobody's going to default on their mortgages, right? Well, those are long-tail bets. Those are really long bets. And if you make one of those bets, right, I'm going to bet you $1 million that crypto is going to go down next year, right? Well, now I have to factor in the fact that I've made this long-term commitment that impinges my ability to make other bets. And as that starts to move against me, I'm really constrained. Because I got to go home and tell my wife, hey, I bet Keith $1 million, and, like, I may have to pay up, and so we're going to have to sell the house and sell the car, and kids are going to have to drop out of college and everything else, right? Like, that's not what we're seeing yet.
No.
But some of those are starting to creep in, right? And so this is where the bets that the Federal Reserve is making that, hey, the economy can handle interest rates that are dramatically higher than we've ever seen, or than we've seen in recent memory.
In a roundabout way, I mean, the bets are getting, like Goldman's now taking down their recession risk to it's always a number that doesn't matter, but 15% or something like that.
Just enough to preserve optionality that goes in the other way, right? I told you there was a chance of recession.
Just enough, right? Right after. I'm not going to get into that, but they've de facto priced out of the market. If you look at historical vol, I mean, like, as far as we can go back on, when you actually enter a recession, you get from episodic to non-trending vol to massive clusters and spikes and trending vol. And this is something that people have only had to deal with. This will only be the third recession in my career in 25 years. So if you've priced that long term out, and everything else is just let's trade the short term, what happens when that intermediate to long term happens? I mean, that is to me like when you wrap it back to the fundamental, back to that hat that just 100%. Won't go away. It makes the game more fun. It makes it more difficult. I think it would be, and we got to wrap up here, but I think the game's always difficult. I mean, I don't know anybody who's a billionaire using a 50-day moving monkey. I mean, that's not a thing. The game's hard. It's just gotten a lot harder.
100%.
And I cannot imagine. I would not play the game. I would retire if I did not use the tools that you guys have added to my toolbox. I just wouldn't. Why would I? I would be voluntarily playing with a handicap that I don't need to have. So thank you for that.
No, it's our pleasure. Thank you for taking an interest.
And if you look hard enough out there, by the way, you're going to find a lot of innovation in this business, which our business needs a lot of it, evolution, and you're just going to find a better way. So thanks for joining us. We'll see you next time.